Welcome back to the ET Money Show. When it comes to life insurance, there are tons of insurance policies that you can choose from to insure your loved one. One of them is money back policy, where the policyholder gets periodical returns from the policy. In this segment, we will give you a lowdown of what exactly are money back policies, their advantages, and how you can get the maximum benefit out of your policy. Let's bring on board Mr. Pankaj Mathpal, who is the MD at Optima Money Managers, to take the discussion forward. A very good evening, Pankaj, and thank you so much for joining us today on ET Now. Let's help our viewers with the basic. What exactly is money back policies and how does these money back policies work?
Srishti, good evening, and thanks for having me on the show. These money back policies are basically, these are traditional plans, and these are also called anticipated endowment policies. So basically, like in endowment policies, policyholder gets the benefit at the time of maturity, but in these policies, there is periodical return. So for example, if the policy has a term of 20 years, so maybe every 5 years, the policyholder will get a percentage of the sum assured. Along with that, because the insurance policy, there will be a life cover available in the policy. So in case the life assured dies during the term, the beneficiaries will get the sum assured under that policy. So it is insurance cum investment plan where the insurance benefit is available, and along with that investment component is there, and the amount is paid periodically to the policyholder.
But Pankaj, is there any time limit where you can actually have to invest on a regular basis to avail the benefits of the money back?
Yeah. See, every policy will have, you have to pay premium. So in the beginning of the policy, so for example, if it's a 20-year policy and it's a regular premium policy, it means every year you have to pay premium. Now there may be a single annual premium mode or half yearly, quarterly or monthly, depending on insurer to insurer. There may be different modes available under the policy. So if you are paying annual mode, there may be some discount on that. For example, if you have taken a policy of 5 lakh rupees and premium is 50,000 per year, and if suppose you go for a monthly mode, there may be some loading, your premium may be a little higher, total premium in the year. But these modes can be made available monthly, quarterly, half yearly or annual.
Okay, understood. But when it comes to surrendering the policy, what is the process? How does the process look like, and how should one go about it?
Srishti, first thing is that if you're buying an insurance policy, then before buying, you should understand the features and benefit of the policy so that you don't need to surrender it. Ultimately, you're buying a policy for 15, 20 years because these plans are long-term plan. All the money back plans are for 15 years, 20 years, something like this. So first thing, before buying, you must read the brochure carefully. You should read the policy wordings. Second thing, if you suppose agent told you something about the policy and after receiving the policy, you feel that these terms and conditions are not as informed to you earlier, you are given a free look period. So every policy comes with a free look period of 15 days if it is bought under offline mode, and if the policy has been bought online, then you get 30 days free look period from the date of receipt of the policy. So once you receive the policy, you must go through it, read it, understand it, and if you are not satisfied, first thing within that free look period, you should cancel the policy so that you will get the full premium what you have paid. Some pre-insurance medical test, if it was undertaken, so those charges can be adjusted. Otherwise, your full premium will be paid back to you. But suppose during the free look period, you do not read the policy, do not cancel it, and you want to surrender later. So you have to understand, first thing, minimum 3 years premium has to be paid. After that only policy acquires the surrender value. And surrender value is much lesser than the premium you pay. So that is why it should be the last option if means you don't cancel it on time and you don't want to continue also, you realize that you have taken a wrong decision. In such case, simply means you have to fill the surrender application form and you can surrender the policy. Procedure is very simple. Original policy, you have to return it back to the insurance company and you will get the surrender value. But as I said, the first year total premium what you paid is not recoverable. On the balance premium, a small percentage is paid to you.
Understood, Pankaj. But now that we have informed our viewers on what exactly are money back policies and if you're looking to surrender one going forward, what should it be looking like and what is the process and pros and cons. But moving forward with the next question that comes to the mind is that this particular policy is something that gives you some kind of an assured returns. So two questions. Firstly is can this policy be looked upon as a second source of income going forward? And secondly, when you say that these are long-term policies, so what exactly is the right age for anybody to start with these money-back policies so that going forward in the future they can avail these returns in terms of the income generated out of these policies?
See, Srishti, if you talk about the age, first thing, whether these are suitable for you or not, that is more important, because when we talk about long term, see, these policies, as I said, will be something like 15-year, 20-year long. So for long term, we all can understand that there are some other products which will give you better returns. So in long term, as asset class, we know that equity delivers better return, or it has potential to deliver better returns. So why somebody should look for this 5-6% returns from a product like this? So I'll say that one should avoid if you are planning for the long-term investment. Still, there may be some investors who do not want to take equity market risk, or they are more comfortable with this kind of products. For them, it may be one choice. Second thing, returns are tax exempted. So first thing, who are in higher tax bracket, they want to invest in such debt products where returns are lesser but stable and tax free, they can consider. Now, who should consider? I'll say that people who are above 40 years of age and who have this substantial income, who are in higher tax bracket and they want a tax free income, because ultimately if a person is in a 5% tax bracket or without in income tax bracket, so in such case, it will not make any sense, because if you get 6% return or 5% return, but for a person who's in 30% tax bracket, getting 6% tax free may make some sense. So I'll say only investors who are in higher tax bracket, they should consider. And as these are long term, so at the age of 40, 45, you're considering, so that it will cover you for a longer duration. That can be right thing to be considered.
Okay, but from the returns perspective, you did touch upon that 5 to 6% is like the average kind of return you can be expecting. So can these policies be looked at as a second source of income going forward, or the return is too low in terms of beating the inflation?
Exactly. Because 5 to 6%, when we see the average inflation, so you are not able to beat inflation. I'll not say that it will be able to serve any purpose. So actually, one should avoid investing in insurance, first thing. And if at all you want to consider, then there can be some market link products where you can expect little higher returns. That can be one choice. But otherwise, in that category, we have products like PPF or NSC or fixed deposit or RBI bonds. So many other choices are available, or debt funds are there. So I'll say that one should avoid as much as possible. Only thing, when you think that tax-free returns, though these are lower, so in those cases, it can be considered. And one more thing I would like to highlight. See what happens when you go for a money back plan. Premium is so high, you cannot go for a policy with a larger sum assured. So if you're buying a policy with a 5 lakh sum assured, 5 lakh death benefit, so it is not actually serving the purpose of insurance. Because if somebody buys the insurance, the life cover should be as much. If a person dies during the term, family should have a sufficient income. So a 5 lakh, 10 lakh rupee policy will not serve the purpose of insurance as well. So you should think about 50 lakh, 1 crore, something like this. So these policies are generally bought by the high net worth individuals, one, to save, to have the tax-free income. Second thing, the people who do not have access to a market, they do not understand much, and insurance agents basically sell them these policies. They hold such policies and these are popular. But if you can understand various asset classes and other schemes, so I'll not suggest that one should go for these money back plans.
But in terms of premium, Pankaj, like you have been highlighting that the premiums are quite very high. So in comparison to the general insurance policies, how much high the premiums are? If you can just give us a number to help our viewers have a sense on that.
Yeah, see, premium varies from company to company. One. Second thing, it depends on the age of the policy holder of the means the person who buys the policy, and younger is the age, premium will be lesser. Second thing, the term of the policy, if it is for the longer term, the premium or the age is high, then the premium may be higher. But still, I'll say, if suppose somebody goes for a 50 lakh sum assured in a pure term insurance policy, and there the premium is say 10,000 rupees, here it will be at least 50,000 rupees. So you can say that 5 times to 6 times higher than the pure insurance policy. And if you compare a money back plan with the pure endowment, means the policy where the benefit is paid to the policyholder only on maturity, compared to here in this policy where the returns are paid periodically, there is at least premium is 50% higher than the policy which gives you benefit at the time of maturity. So compared to endowment, in this policy, it is 50% higher.
But Pankaj, when we talk about or consider the insurance policies, then we also take into note the benefits for riders. When it comes to this particular policy, is that advisable to go for the having and adding on to the riders as well? And what are the benefits that one should be looking out for?
Especially first thing, you have to know what riders are available, because it will vary from insurer to insurer and product to product. So not that all policies will be available with all the riders. So if suppose you go for a policy where accidental death benefit rider is available, or disability benefit rider is available, or there may be a income benefit rider, something like for example, income benefit means this comes usually with the policy where the person is, if for example get disabled. In such case, a certain percentage of the sum assured is paid to the person regularly for few years. Or as I said, that there is a disability benefit rider. If person gets totally disabled, so a lump sum amount or a amount in installment is paid to the policy holder. Or there may be a additional death benefit rider. In that case, if a person dies in accident, so additional sum assured is paid to the beneficiary in that policy. So there can be this kind of riders. So if available, I'll say that this disability benefit rider is very useful, because if a person becomes disabled and cannot pay even premium, so that time and even because person had not died, so even sum assured will not be paid. In such case, benefit under the disability benefit rider can be very useful.
Understood. So disability rider is something that you should be looking out for. But Pankaj, now that we have informed our viewers exactly on what is a money back policy and what are the various factors, and even in this particular category, who are those customers that are actually willing in going and buying this particular policy, that brings me to the question that now if somebody has bought a money back policy, how he should make the most out of it, and what are the factors that he should be considering and taking a note of?
Yeah. Srishti, I'll say, because as these are money back plan, so you will get periodical returns. Now, as I said, the returns are very low, but whatever money comes back to you, if that is reinvested in the schemes which can yield higher returns, so at least your average return from the policy can be better. Means suppose you have bought a policy of 10 lakh rupees and you got 2 lakh rupees money back after 5 years. So if you invest that 2 lakh rupees for next 15 years in some equity oriented products where you have the scope of earning better returns. So maybe at the end, when the policy matures, by the time these amount which have been reinvested will also give you good returns. So put together, you may have better returns. That can be one option.
Okay, thank you so much, Pankaj, for highlighting all the options that are available for our viewers. With this, we'll let you go on that. It was great chatting with you on ET Now today.
Thank you very much.
So that was all about the money back policy, viewers, where we told you that what exactly is the money back policy, because from the name itself you will get to know that it is a policy where you get your money invested back to you. But what are the factors that you should be looking out for is something that we try to highlight for you. But